how do these moms and pops run their facilities? Well, their big KPI, key performance indicator, is occupancy. They just want their units full because the last thing they
Yeah.
want to do is have to deal with any kind of technology or a website or a marketing program or anything related to, filling up a unit, because it's just not how they're wired, right? They're not going to
Yeah.
the industry conferences. They're not leveraging the latest technologies. They're not monitoring their competitors, right? And so that's what we come in and do. We bring in the technology, we bring in the software, we bring in the team.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Hey everyone, this is Ted Patel, and welcome to this week's edition of Decoding Cashflow podcast. I'm here with Tom Dunkel of Belrose Storage Group, and we are going to dive deep into self-storage investments. Tom has been investing full-time in alternative assets since 2006. He specializes in fragmented, dislocated markets such as distressed debt and self-storage. Tom is the Chief Investment Officer at Belrose Storage Group that specializes in acquiring underperforming self-storage facilities in Eastern US and turning around the performance of the asset in a condensed time frame of 2 to 3 years. Tom, welcome to Decoding Cashflow.
Thanks, Ted. It's great to be with you and all the listeners today. Appreciate you having me.
Awesome. So before we dive deep into into your niche, right? I'd like you to give a little bit background about yourself. How did you get started in real estate, and what is your current focus?
Sure. Yeah, happy to do so. So, I was actually in corporate America after I got out of business school. I was with some technology companies. We were growing aggressively through acquisition. I was in the aerospace industry and the IT services industries, third-party logistics. So I was moved around to a couple different companies that were growing through acquisition, but all looking to leverage technology. Of course, this was back in the late 90s and early 2000s, when everything was hot and heavy with the new internet ideas and grabbing eyeballs and all that stuff. So that was in a fun and exciting time. And I definitely learned a lot about, bubbles. That was my first bubble, actually, was when I was in investment banking in the early 2000s and the technology bubble burst. So that was
I was also in the investment banking during the same time frame. Actually, I used to work with investment banks on Wall Street, right here in New York.
Yep. I was in Philly, but yeah, it was. I don't know about your firm, Ted, but my firm went from I think it was about 120 people or so down to 5. I was not in the remaining 5 people. So had to that was probably my first experience of really having to go out and reinvent, which seems to be kind of a theme throughout my career. Like I've had to run up against certain obstacles and then had to kind of figure things out and keep moving forward. But yeah, so I ended up getting into real estate full time in 2006 after I got fired from my corporate job at Nutrisystem. So again, had to face some adversity and kind of figure things out. But I was determined to go out and do my own thing. So 2006, I jumped into real estate. Of course, I didn't realize what was coming around the corner over those next few years. So definitely learned a lot of hard lessons up front. But as challenging as that was, I was determined to kind of keep grinding through. So, I've been involved in a few different asset classes along the way, but we have since built a team and a business and systems and procedures and such so that we can properly execute. But we found ourselves in self-storage because there's a lot of super attractive characteristics of that market, which we could get into. But we've been doing that. We started looking at it like 2017, 2018. 2019, we put the team together and put our plan together, and then we didn't acquire our first facility till after all that was set in August of 2020. So since then, we've acquired 14 facilities, over $40 million of storage, over 4,000 units across 7 states in the eastern US. So that's what I've been up to. It's been quite a journey.
Wow, that's great. And I hope you didn't started investing when you started investing 2006, right? I hope you didn't lose anything when the 2008 bubble busted.
Well, of course I did. Of course
Yeah,
I
because
did.
it was the peak of the market, right, at that point
Yeah,
of time. So
exactly. So
yeah,
here I am, I'm leaving corporate America in I guess the silver lining was I was a VP of finance at a
yeah,
Nutrisystem, which is a big publicly traded
yeah.
company. So I left with a nice kind of exit package and some options and whatnot. So that was kind of the seed capital for my real estate empire, which of course I just burned through all that those next few years as the market kind of came against me, and I was still trying to figure out what the heck it was to be an entrepreneur and that sort of thing. So yeah, it was it
Yeah.
was a tough few years, but
Yeah. Yeah, it was tough, but it followed by that the period after 2008, it was like a opportunity time, for the investors who were on the sideline, who were grinding like you, right?
mhm.
Who wanted to stay in the market regardless of what
Yeah,
happened. That was a golden period for
yeah.
those kind of investors. They reaped a lot of benefit during that downturn.
Absolutely, and
Yeah.
I was actually one of those. So
Yeah.
I shifted my focus and I connected with my business partner Joe Downs. We've now been business partners going on 14 years. But back then, in 2009, I started learning about distressed mortgage debt, and we started buying pools of distressed mortgage debt with the few bucks we were able to scrape
Yeah.
together after the crash in 2010. And so, thankfully, we got into that business. We made some key relationships. And so we've been able to generate over $53 million of revenue in our distressed mortgage debt business over the years, which has allowed us to kind of test
Mhm.
out some other asset classes along the way. But yeah, that was a big benefit that didn't little did we realize at the time that we were going to be able to build this pretty big business, which is still thriving today. But it's just one of those things you just have to kind of keep exploring, keep trying, and keep
Yep,
grinding, like you said.
that's true. And tell us about your first self-storage acquisition. How did you get that opportunity?
Yeah, great question. So as I mentioned, we were pretty intentional about what we wanted to do. We put the
Mhm.
team together, and it was kind of through sort of a mentoring and mastermind process that we realized we had these gaps in our team. So through that process, we were able to pull in people and fill those gaps. Because prior to then, Ted, like I don't know, people out there who might be new to real estate or maybe a little uncertain, when you're in that position, you're really at a competitive disadvantage because you're making offers and you're really kind of lowballing your offers, like,
Yeah.
and kind of hoping that they're not accepted because you don't really know what you're doing, but you're trying to get in there and make something happen. So when we had that team put together and we had our plan put together, it really gave us the confidence to then go out and make like legitimate offers on self-storage facilities, because we could now really analyze the numbers. We had a team together so we could credibly go to investors and raise capital and go to the lender and get a loan.
Mhm.
And so when that opportunity came about, it was just kind of a networking sort of thing. My partner Tim, he went to a self-storage networking event and met a broker, and the broker had a deal. And next thing we're putting in an offer, negotiating the purchase, and so it came together pretty well, came together nicely, and it was a kind of facility that we really continue to look for today, Ted, which was an
Mhm.
underperforming asset, right? So even though it was owned by a big real estate company, it was kind of like a forgotten asset because it was smaller. This particular
Mhm.
company was looking at doing, bigger things like an office and industrial and those kinds of things. And so this asset was just sort of left to the side and wasn't really focused on. And so as a result, it wasn't performing very well. So we came in, brought our, full attention and our expert operations team, we were able to turn that facility around and make a really nice profit in about 18 months.
Awesome. And what do you look into, or in the other words, I would say, what are the main criterias that you keep in mind while looking for these self-storage opportunities?
Sure. Yeah. So when it comes to the subject property itself, we're looking for rents that are below market.
Mhm.
And you'd be surprised when we see it all the time now. So we're used to seeing it, but someone who's new to this kind of thing might be surprised by the fact that there are a ton of facilities out there that are mom and pop owned, where their rates are like 20, 30. We even acquired a facility with rates 40% below market. And you might think to yourself, well, how are these opportunities even out there? Well, the reason is that self-storage is a super fragmented market. And what does that mean? Well, those big names that you've heard of, Public Storage, Extra Space, CubeSmart, they only control about 35% of the total self-storage market. So the remaining 65%, call it, are what we call middle operations companies like ours. But then there's a ton of like onesie, twosie, what we call mom and pop owners. And how do these moms and pops run their facilities? Well, their big KPI, key performance indicator, is occupancy. They just want their units full, because the last thing they want to do is have to deal with any kind of technology or a website or a marketing program or anything related to, filling up a unit, because it's just not how they're wired, right? They're not going to the industry conferences. They're not leveraging the latest technologies. They're not monitoring their competitors, right? And so that's what we come in and do. We bring in the technology, we bring in the software, we bring in the team. And so we're able to confidently push our rates, sometimes to the top or maybe even higher in the market, because there's a whole other, kind of consumer behavior aspect to self-storage. But those opportunities are out there. And so that's what we're doing here at Belrose Storage Group, is taking advantage of those sub-performing assets.
Yeah. And one thing I would like to add is, you mentioned this mom and pop, self-storage owners. They try to keep the occupancy 100%, right? And as you know, like when you see 100% occupancy, it straight away comes to your mind, the rents are too low.
That's right.
Right. Because normally, I think in self-storage, I'm not sure how much it were, what is the average percentage in self-storage, but in multifamilies, normally it's around 95 plus or minus, give or take, right? So if you see anything like above 98%, it means your rent is too low. You need to now increase the rents.
100%. Yeah, you're spot on, Ted. In fact, I have a buddy of mine, grew up in the hotel business. And this was long before I even looked at self-storage. He was telling me with their hotels, like if they're over 90% full, they're not charging enough. Because you really got to work that supply and demand curve, right, to your advantage. So so you're spot on. And that's kind of what I alluded to earlier with the consumer kind of behavior aspects, is especially in self-storage, because at the end of the day, if it's a $200 a month unit, for most people, that's not going to make or break their family budget. So if it goes from 200 to 220, that's they're not going to be happy about it. But that $20 increase, you multiply that across a whole self-storage facility of fully units, and you multiply that out by 12 months and you put a capitalization rate on that. I mean, any little rate increase can result in hundreds of thousands, if not millions of dollars of added value to a self-storage facility.
Yeah, it's just 10% increase, right? It doesn't matter for the for the individual who is renting it, but it adds like, in the NOI, it increases exponentially.
That's right.
10% increase might add up to maybe 20% increase in NOI.
100%. Yeah, absolutely. And, $20, I mean, in a lot of places, I'm sure up in northern Jersey where you are and outside Philly where I am, I mean, that's lunch, right?
Yeah. Yeah. What are the other value adds that you do once you acquire the new facility?
Yeah, great question. So one of the big things we do is we use what we call a hybrid management structure. So
Okay.
there's a human assigned to each facility, but they manage those facilities remotely. So instead of having one facility manager sitting at a facility and mostly twiddling their thumbs all day, we have one manager who can manage 3, 4, 5 facilities. And we leverage technology to be able to do that. So I don't know if this will be on video, but I'll share a little with my little background. It's kind of hard to see, but we
Yeah.
have a QR code. Whoops.
Yeah, I do
That
see that.
goes, yeah, we have a QR code that's on the fence, on the gate at each of our facilities,
Okay.
because it's the number one reason that a customer rents at a particular facility is because they've driven by it. And with our remote management structure, it's like, okay, well, the chances of someone driving by and someone not being there are pretty high. So we have a QR code on the fence. So the consumer will scan the QR code, they can select their unit, they can fill out their paperwork right there, sign with their finger. They can enter in their credit card information, which is a beautiful thing because then it becomes like a Planet Fitness membership where it becomes more of a pain in the butt to cancel it than to just keep going with that, those increases that come along from time to time. And then once they finish with that, they get the gate code texted to them. So they punch in their gate code on the keypad, they drive to their unit, empty in their stuff. There's a lock in there waiting for them. They lock it up and they're on their way without any interaction with a human. So that's a huge leverage point for us.
Awesome. So everything is like remotely controlled, looks like.
That's right.
So
And if you
it
think about
reduces a
it,
lot of cost, right? It reduces a lot of but
exactly.
the facility manager, right, that you say he operates or takes care of 3 to 4 different facility at the same time. He
Yeah.
would be visiting these facilities on the regular basis, though, or just to
You're
keep a check
exactly
on
right.
them. Yeah.
Yeah. So they're required to be on site, boots on the ground at a facility 3 to 4 days per month. And because of course some things you can't do over the internet, right? You
Yeah.
can't pick up trash, you can't, fix a fence or a gate, you can't, check
Yeah.
on the, the mail, whatever. So we do have that requirement of our managers. And then in addition to that, if there is an emergency, because of course there's weather, we've had facilities hit by tornadoes, but we
Yeah.
do have usually someone that's on call in that market that we can just reach out to on an as needed basis.
And you might have the remote monitoring facilities also at all those storage
That's right.
facilities.
Yes, we have cameras. I'm sure folks out there are familiar with Ring or Blink cameras. We have the same kind of thing on the commercial basis at our storage facilities where we can actually talk to customers through the camera.
Yeah, that's great. Right. And while selecting any specific market, right, or a storage facility within that market, what is the price or I would say square feet per population that you look forward to?
Yeah, good question. Yeah, and I meant to get to that earlier, but I don't know, in my older age, I tend to get a little long-winded. But no, I was talking about earlier, I was talking about looking at the subject property, but you're spot on, Ted. You need to look at the market, what's going on in that market, right? Similar to multifamily and other real estate asset classes. So yeah, 100%. We're looking for a healthy economy. We want a steady or growing population. But just a side note about that, we don't want to be in an area where it's growing too fast. We're really looking for kind of that Goldilocks scenario, because if it's growing too fast, that's going to be attracting the big guys,
Big
the Public
guys.
Storage, Extra Space, Life Storage, et cetera, who are super well capitalized. They can come in, build this huge, beautiful facility, and suck up all the demand in that market pretty quickly. But we also don't want it, declining, right, or too slow. So we're looking for that Goldilocks scenario, which again is why we a lot of times will end up in the secondary or the tertiary markets. But we're also looking at things, like poverty. We want to look at employment. We want to see if capital investments are being made in infrastructure and those kinds of things. But those are kind of the key, and the household income, of course, we're looking at. So those are some of the key things that we're looking at in the market.
And what is your average price per square foot, or maybe not price per square foot, total square foot per population that you look at? Like it is $6 or $8, $12, $10. What is the main?
That's right. Yeah, you did mention that earlier. So it kind of varies by market, but what you're referring to is what we call a supply index.
Yeah.
So it's how much storage is in a particular market as a function of the number of people that live there, right?
Yeah.
So in some markets, equilibrium is going to be like 10 feet per square foot, where that's going to be a market where self-storage is a lot more adopted. But then there's going to be other markets where the equilibrium might be more like 6 square feet per person. It's just one of those things that varies from region to region. But it is something that we look at, but it's not kind of the be all end all. So we've acquired facilities in markets where the supply index might look high at first, but if you go into a 10 square foot per person market, but we do our analysis of our 3 or our 5 mile radius, because that's really our market. If we look at the competitors in that ring, if they're all full and their pricing trends, their rate trends are going in the right direction, that tells us that there's still some unmet demand in that market, so we can feel comfortable going into that market. And then similarly, if it's a low supply index market, we might find that there are facilities in that market that are only 50 or 60% occupied, which tells us for whatever reason that there's not a lot of demand there. So it's definitely something we spend a lot of time looking at, Ted, when we are evaluating a market where we're targeting a property.
Any specific websites or newsletters that you can recommend where you can find these data for analysis?
Yeah. So well, of course, there's Google, which is free, right? If you Google a particular address, right, you can say self-storage near 123 Main Street, Paramus, New Jersey, and it'll give you a map of all those facilities, and then you can go in and you can call each of those facilities and say you're looking for a storage unit and see what they say. See if you can chat up the whoever answers the phone and see what they can share about the market. So that's the free way.
Yeah.
There's actually 2 pay databases that we use, and one is called StoreTrack, which has a lot of great demographic information in it. It actually has the supply index, kind of calculated in there. But of course, like any source, right, there's going to be errors in it or omissions, that sort of thing. So we actually have another database called Tract IQ, and this is also a self-storage specific database. And the cool thing about this one is it allows us to not only see the competitors in our area and their occupancy and their pricing and things like that, but it also tracks things like housing starts. So we can see, like, kind of going back to the supply index, like, hey, the supply index might be 8 or 10 right now, but there's building, this huge neighborhood down the street in our market, in our 3 to 5 mile radius. And so that's going to increase the population, which is going to decrease the supply index, which would be good for us, and so it'll create some more customers. It also tracks something that they call commercial influences. So like it'll track like if there's a new Starbucks coming in, or a new Walgreens, or it can track sort of those, or a new school. It'll track some of those larger infrastructure investments and commercial investments. So I think what a lot of commercial real estate people do, right, is they try to find out, like, where's Starbucks going, and then they want to be near there so they can build on
Yeah,
those smart people over at
all
Starbucks.
the research is done by Starbucks. You
That's
leverage
right. We
that
piggyback
research.
on it.
Yeah, piggyback
Absolutely.
on it. Yeah, exactly. So, Walmart, Starbucks, many other you can follow. Yep.
Correct. Yeah. Yeah.
And what's your average cap rate in the storage facilities? Like, what is your targeted cap rate? In the other words, I would say.
Sure. We'd love to find, 15 caps out there.
Yeah, but
No, but again, that's something that varies, market to
yeah,
market. But generally over the last couple of years, we've been buying in the on the low end, we've bought at like a 5.25 cap, and that was a
yeah.
very robust market. And then, but in self-storage, we've still been able to find like 8.5 cap deals
Oh
here and
wow,
there,
that's
here and
great.
there. Yeah, yeah.
That's
So
nice. Yeah.
that's been certainly helpful, especially with interest rates going up, right? You
Yeah.
want to try to maintain that spread between your cap rate and your cost of funds.
Cost
So.
of funds, exactly.
Mhm.
What do you think about the current upcoming market, like in the future? Right now, it looks like the interest rate is almost stabilized. I hope it doesn't go up anymore. You know, the
Yeah.
10-year treasury, it reached around 5 before a couple of months. And now it's up at 4.2 something. So hope I see the trend down. Hope it stays the same. What is your thought on it?
Yeah, I'm seeing a little bit of that too, Ted. And I was just looking at some numbers this morning. Looks like inflation is definitely starting to cool
Yeah.
off. There's
Mhm.
been, unfortunately, we're having to look for bad news. Bad news is good news, right? So like, there's been a lot of layoffs and that sort of thing,
Yeah.
which is unfortunate, but it is, I guess, what the Fed is trying to do is get the labor market specifically to really cool off, because that's been one area that the higher interest rates
Yeah.
hasn't quite tamped out that fire yet. And that's been a little persistent in terms of, kind of keeping costs high.
Mhm.
But I think, I'm hopeful that next year, as we're here at the end of 2023, entering 2024, I'm hearing that, maybe, the analysts are all thinking, that rates will be coming down. I mean, I hope that's the case.
Yeah.
But here, we're planning for rates to kind of stay higher for longer, as we're doing our modeling and our forecasting for our values, and which is what we do to come up with our forecasts for our investor returns, right?
Yeah.
So we're still being pretty conservative on our back end exit assumptions, looking at higher cap rates in the future. But hopefully they will come down, which will benefit our
Mhm.
investors. But that's just our culture here, and it just comes from my background in mergers and acquisitions and corporate finance, to kind of under promise and over deliver is what
Yeah,
we
that's
what we
true.
really try to
Yep.
do, because we want our investors to be happy, we want our lenders to be happy.
Yeah.
So we'd rather kind of lose out on kind of a questionable deal, than force something than do a deal that's not going to help anybody in the future.
Yeah. And before we start recording the show, right? We talked about your venture into ground up construction. So maybe let's talk a little bit about that. Where do you see promising? What are the promising areas for ground up construction according to you right now, or which specific markets you're looking for?
Sure. Yeah. We've been looking at a lot of development potential opportunities down in Georgia and the
Okay.
Carolinas.
Mhm.
We're avoiding Florida right now. There's just between the taxes and the insurance,
Yeah.
it's just there's just and just the flood of building and stuff going on there is just
Mhm.
really causing us to kind of look in other markets. But development's tough right now because the cost of money is challenging.
Yeah.
And that's a big driver of development. So we've had some things teed up for a while now, where we're working through the soft cost part of the development. So we're working on the architectural drawings
Mhm.
and the permitting and the zoning and all those kinds of things. But until we can get to a point where the numbers pencil out on the lending side, Ted, it's
Mhm.
we have some things that we're just kind of slow playing,
Yeah.
because we don't want to jump into anything right now.
Right. Normally in the ground up construction, because I come from the same industry, right? Ground up construction. You might be doing for the storage facility. We do for
Mhm.
the luxury single family homes as well as the multifamily properties. But
Mhm.
so I'd like to know what is the per square foot price that on an average for storage facilities.
Yeah, so a couple years ago it was probably, $65, $70 a foot,
Okay.
and now we're up to, 110, maybe even pushing
Wow.
120 per square foot. I think it's come down a little bit, but that's where it kind of topped out
Mm-hmm.
last year. But yeah, we're about $100 per square foot, give or take. Depends a little bit market to market, but
Is it mainly because of the increase in the land value or the cost of construction?
cost of construction, cost of materials, cost of labor.
Mm-hmm. Everything.
Yeah,
Yeah.
everything. That's
Yeah.
right.
All right.
Yeah.
So any current site, active current site for the ground up construction you're working on?
Well, we just finished a big expansion down in Lynchburg, Virginia. So
Okay.
we acquired a facility that had some extra land with it. And
Mm-hmm.
so we built some brand new units there, which we just opened that up about a month ago. So that's been great. That was a great experience. We definitely had some delays in terms of, this, that, and the other thing
Yeah.
with supply chain issues. And then we had a bunch of weather problems. So the time frame got stretched out longer than we would have liked. But the good news was we at least stayed on budget, dollar wise.
Uh-huh.
But one of the facilities, one of the ground up opportunities that has been kind of hanging in the balance because of the interest rate environment right now is up in New York State. We acquired a facility up there about a year ago, and it came with some land next door. And so we've been going through kind of those soft costs, the architectural drawings, permitting, zoning, et cetera.
Mm-hmm.
And but the interest rates and kind of the lending environment is causing us to have to sort of slow that project down a little
Mm-hmm.
bit until we can get appropriate financing. So that's unfortunate, but it's just kind of the way the world is working right now.
Yeah. It takes some time, just to get all the approvals, everything in place, depending on the where it's located, right?
That's right.
Yeah.
That's right. And when we acquired the facility, it came with some plans, but then of course we found out that the plans weren't quite as far along toward approval as we were led to believe. But that happens, and
Yeah.
so we had to kind of go back to the drawing board, which is and then of course the capital markets sort of shifted against us. But yeah, that's just business, right, Ted?
Yeah. It's a part of the game.
Yeah.
Yeah. And now talking about raising capital, right?
Mhm.
Of course, you do syndicate the deals. So can you tell us something about your debt structure, your equity structure? How does it work in your company?
Yeah, sure. Well, one of the big things we like to do here is at Belrose Storage Group is help passive investors grow their wealth through real estate. So, we think self-storage is a great vehicle to do that. So, what we do is we typically are getting loans from to this point, it's been smaller lenders, so credit unions, smaller local banks.
Okay.
A year or so ago, in fact, we almost exactly a year ago, we had a lender offering us 80% loan to value financing. And at the time we
Mhm.
said, hey, thanks, but no thanks. We see some challenges coming. So we're just going to take 75%. So,
Mhm.
and we're glad that we did that, and the numbers still worked. And, it's our way of looking out for our investors, because you don't want to get over leveraged, right? So these days we're typically in kind of the 65-70% loan to value range
Yeah.
from the lenders. And those rates are in the kind of the high sevens to kind of the mid eights, kind of depending on the lender you happen to be talking to. Unfortunately, we've had we've had a few deals actually where, the lender has sort of shifted terms toward the end, and we've had to kind of scramble. And so anyway, it's just kind of where we are in the world right now. So the lending side's a little challenging for sure. As far as equity investors go, we've been building up our equity investor partner list for a while now. We were talking before we got on, Ted, about how, it started out just kind of friends and family and putting in our own money and that sort of thing. But with our company growth goals, we've really been expanding out, which frankly is why I'm kind of doing the podcast tour to get us out there, and hopefully investors will want to hook up with us. But because we do put our own money into our own deals, and because of my background in corporate finance and mergers and acquisitions and being very conservative, we're definitely looking out for the deal, looking out for our investors. And so we like to underpromise and over deliver. But our investors are typically, making like a mid to high teens overall average annual return over like on what we call a plain vanilla value add deal, where we're just going in, improving the operations, technology, et cetera. Yeah, it typically doesn't take more than 2 or 3 years. So we're able to get in, do our thing, and get out. And I think that's attractive to some investors because a lot of real estate deals, right? You might have your capital tied up for 7 years, 10 years, which, that's a long time, right? When we do have a development or some kind of expansion or conversion going on, our timeline might stretch out to 4 to 5 years. But generally, we're trying to keep under that. But our investors are getting monthly payments along the way, just to wet their whistle along the way a little bit. And then when we sell the property, they get their capital back, and there's a profit split that gets them to that those kind of mid to high teens is the target. Now to this point, we've had 3 exits. All 3 of them have exceeded our projections. So our investors are happy about that, and they come back to our next deal with more money, and they bring their friends. So that tells us that we're doing a pretty good job.
Awesome. All right. Hey, Tom, we're really enjoying this conversation, but I want to be respectful of your time, so let's switch gears and move to the final round of questions. Are we ready?
Sounds good. Yeah, let's do it.
All right. Okay. So what is the 1 or 2 books, I would say, that you'll recommend that has the most impact in your business on your life?
Sure. So on the business side, I'm a big fan of Who Not How by Dan Sullivan and Benjamin Hardy. As entrepreneurs, right? Like a lot of times we just like to, smash through walls or do whatever it takes to get something done. But, at this point in my career, I'm looking for maybe a little easier way to handle those kinds of things. And so this book just highlights the fact that, if you run up against an obstacle or a question or a problem, you don't know the answer, chances are there's somebody out there who's an expert or, knows how to navigate that for you. And so you just got to, make those relationships and instead of, smashing through the walls and injuring yourself, go find that person who can, help you out with that. So I'm a big fan of that. We're here at Belrose Storage Group. We talk about that a lot. And so we especially now with the ability to bring in virtual assistants and that sort of thing, Ted, for pretty inexpensive, we're able to overcome a lot of those obstacles. But I would encourage folks out there to maybe get out of your business book rut. And one of my favorite books of all time is not a business book. It's called The Last Place on Earth. And it's a story about the explorers in the early 1900s who were trying to get to the last place on Earth, which was the South Pole. That was the last place that was yet to be explored by people. So it's a great story about, you got this Norwegian like hippie guy, Amundsen, and he's putting together like his merry band of brothers to go down to the South Pole. And then they're up against, the very well-funded, very arrogant, very large English Army or English Navy. And so the British Navy. So I'll just, kind of leave it at that, but it's a great story to see how they each approached this excursion very differently.
Awesome. Yeah. And the Who Not How, I know it's a great read. It's one of my favorite book too. Just gives a totally new perspective on how to get things done. If you don't know the answer, as you said, right, someone else knew. Just try to approach the right person at the right time, and the ball will start rolling.
Yeah.
And so what is the best business or investment advice that you like to give to our listeners?
So for on the business side of things, for me, like getting around the right people and building the team is so important. And then along with that, getting into a niche. We've made mistakes before trying to get into businesses that were just super, super competitive. Like we tried getting into the hard money lending business here outside in the Philadelphia market. And I mean, it's super competitive, and, we just didn't really have the right people. So we failed at that. And then we did such a bad job with it. We thought we'd try it again. And so we failed twice at it. But anyway, I think that's really important. And getting yourself educated, getting the team together, finding that niche and getting educated, going really deep into something narrow, I think is the best way business wise. As far as investors, I would say, a few things. One is I see a mistake that investors make too often. They focus immediately on the deal, right? It's whether it's a self-storage deal, multifamily deal, if it's a luxury home build deal, whatever it is, they start looking at the deal right away. They really need to start by looking at the sponsor, right? Who's actually running the deal and what is their track record? What's their background? Are they investing in the deal? Have they done this before? What's their, track record been on deals they've exited? Just get to know the sponsor a little bit more, ask a lot of questions. Yeah. I mean, if you're getting ready to write a, $50, $100, $250,000 check, that gives you the right to ask some questions of your sponsor.
Absolutely.
Make sure they're a team too. Like it's not just Joe sponsor at, gmail.com, right? You want to see that it's like an actual company with a team and core values and purpose and, all those things.
That's rightly said. Of course, it's like, are you betting on the horse or on the jockey? The same thing comes up, right?
That's right.
And what is the best? What is your main source of information to learn and grow?
Wow, that's a great question. I would say my mastermind groups. So, I've listened to some podcasts here and there. I know there's a lot of people listen, religiously to certain podcasts. I haven't quite gotten into that yet. But I do read books or listen to books, but I do get the most out of my mastermind groups. And I belong to two right now. One is specific to self-storage, and the other is specific to capital raising for real estate. So those are really the two groups. Like if I have they're my who, not how, right, Ted? So like if I have a problem, I think about the who's that I know in those mastermind groups that can help me navigate. But for where I am right now, those are kind of my main sources of information.
Awesome. All right. The last question, Tom, where can Decoding Cashflow listeners get in touch with you?
Sure. I'd love to hear from anyone who has a question about, self-storage or investing or life or whatever. But yeah, I'm Tom Dunkel. I'm the Chief Investment Officer here at Belrose Storage Group, and you can find us at belrosestorategroup.com, BELROSE, storagegroup.com. And if you want to send me a text message at 610-761-8940, I will tell you the famous astronaut that I had lunch with back when I was just doing mergers and acquisitions in the aerospace industry.
Oh, that's interesting. Who was that? Maybe we'll take it on the side.
Yeah,
after the call.
I'm not going to spoil it, Ted. They
Yeah, that's what
me.
I'm saying.
610-761-8940.
All right, Tom. It was a pleasure talking to you. Thanks for taking out time and being on the show.
Thank you, Ted. That was a lot of fun. Appreciate it.
All right. Take care.
Thanks for listening to Decoding Cashflow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cashflow, and we'll catch you in the next episode.